This is mind-boggling stuff. Most people do not comprehend this.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. You know, Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We bring you exclusive access to experts and exclusive access to insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on here in the precious metals industry. So get ready for another packed episode of Live from the Vault. And again, we bring you the knowledge and the understanding that the mainstream media just won't provide. So just before we head over to the UK, please help keep spreading the word about this channel. You know, when you hit that like button right there, if you like the information that's valuable to you, it really helps out the channel. So when you share the information, that helps. And if you haven't already subscribed, do so. Now, if you click on the bell right there, we'll notify you as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, awesome to be here. Look, we got a lot of really positive feedback from the community following our last market update here on the 18th of September, just 2 weeks ago. You walked us through how gold had just blown through the BRICs central bank buy stops that you had identified that were waiting to be triggered at 25.50. And these central bank orders were so large that you had indicated that no matter what the upcoming FOC decision was going to be, that this event had already successfully anchored the next physical stair-step support level that we could rely on. But you'd also identified a similar weighting, central bank buy stop levels that were going to become a magnetic $100 higher at 26.50. And we see that this stair-step that you were talking about is really playing out here as you expected. Can you connect the dots here for the community and what you see as we head in right now to the first week of Q4?
Excellent to be with you, Shane. Thanks for the great questions. Let's get into them as quick as possible. So yes, there are lots of bullish drivers really now coming into play as we enter buy season. But and we're talking about Indian festivals, we're talking about massive buy season now. But to answer these really great subscriber questions, perhaps we start this episode by looking at what we see very short term into current, very thinned out golden week liquidity. That is because China is now on holiday for the week. And so the upcoming, this is a perfect time for thin liquidity. The obligatory synthetically market driven non-farm payrolls volatility. We always get it. Especially if there's thin conditions like we have now. And you'll know what that is when this episode's released on Friday. Then as much as we did before FOMC ahead of the third quarter ending, now let's start to look at what to expect as we've just entered the fourth quarter. So let's start by picking up the short-term thread from the 18th.
Yes, so here's where we were when we recorded our last episode on the 18th. And as we know, we always record just between the AM and the PM fix to keep it consistent. And essentially, this is where we're recording again between the AM and the PM fix. It's about 2:15 in the afternoon UK time. So just picking up from the thread here, look, there's little doubt that officials had begun intervening in gold ahead of China exiting the gold market. They did that on Monday, and Monday the 29th. So they exited the last AM fix, basically, where China was present, was fixed above a very important point, which is a level that they blew through, was this buy stop level, which is essentially in spot terms 26.50. Now it's a slightly different level in futures because there's a premium for this chart represents futures. So you have to so it indicates the slight premium. It's about $20. And that expires, this December contract expires at the end of November. So just to explain that, we've been through this before, but essentially this was the point where China exited. Now, the minute they exited, what happened? Well, this is really, I'm just going to really look at the footprints very, very quickly on the short-term basis. And then we'll obviously move into the more important stuff. But as we know, the Fed is the only global central bank that is capping gold. It's extremely wrong-footed, and they were likely to try and take advantage of the thinner liquidity to try and trigger a COMEX-driven synthetic market sell-off. Their immediate focus was on the gold and silver October's futures bets. Well, that was a bit ahead of China going away. And this is exactly if you remember, when we go into an options event, there's always a bit of a discount going on. And in particular, this is the point when the October contract went into first notice. So as soon as it went into first notice, that meant that all the gaming suddenly had to be funded. So while this is all 96% leveraged, this now indicated that whatever was sitting there wanted delivery. So what we saw was a bit of, and again, I'm just going through the footprints. We've been through this 100 times, but this kind of action is quite normal. Then what we see is them short covering. Then at 2 a.m., we see some selling. And then essentially, this is where the point where China exited. And again, these options events really relate to the exponentially larger multi-billion-dollar OCC, that's the Office of the Comptroller spot market FX bets. We've discussed them many times. And given foreign exchange gold is actually NSFR compliant, so technically these are deliverable, these related asymmetrically skewed 96% leveraged COMEX bets, i.e. meaning that simply they're not one-to-one. So a long position in gold has to be 100% deliverable. A COMEX position is 96% leveraged. So obviously you've got this degree of asymmetric dislocation. So essentially what that meant was the COMEX bets, these COMEX bets right here became vulnerable to being exchanged for physical, i.e. the backdoor of the COMEX, and indeed into a 6,000 lot. And right here, the reason I'm pointing this out is into a 6,000 lot contraction of open interest, i.e. they were bailing. 7,280 lots, that's 22.58 tons, was transacted at this very low of the day. But what was missed was this occurred into a spot gold $3.50 premium to what suddenly became a delivery October contract. Since then, as of Tuesday, as of now, we have now evidenced over 33 tons of, and this was the mark-to-market point here, 33 tons of October contract deliveries, as well as 43 tons that have been exchanged for physical into NSFR compliant, physically like FX gold markets for settlement, with still 1 ton to be delivered. Now, given that it would be prudent to have discharged these October delivery obligations on the first day of October, which to avoid carry costs, etc., the fact that they're being dragged out telegraphs these paper bets are still standing for delivery have to have been delayed as long as possible in the hope that they could kind of cash settle some of this, many of these liabilities before they drain out of the casino into dips that they can create. But these outflows are draining what little COMEX supply there is to fulfill these cash-settled bets. And this is why we've evidenced bid-pulling efforts to try and trick out as many speculators as possible. However, the game has been figured out by Asian buyers, which is why dips are being quickly capitalized on. Now, in an attempt by the PPT to cap the rising price of gold, the Fed's agent banks are currently holding nosebleed high levels of short positions. Now, these same banks are long NSFR-compliant foreign exchange gold for their own book, and therein lays the battle line. The Fed has to utilize the 96% leverage afforded to them by the crumbling casino, but their Achilles heel is this EFP mechanism, which opens up these leveraged bets to be crystallized into deliverable foreign exchange gold, which when it lands in London becomes BIS compliant, Bank of International Settlements compliant, and can be demanded for T+1 physical delivery the very next day. I'm just leaving this chart open again, this is the 2nd of October. It is between the AM and the PM fix. So I'm just leaving this over. In fact, it's gold is rising up towards the fix. But so just to really reaffirm, given the COMEX is structured as a non-delivery paper market exchange and is structured to be cash settled, their Vegas-like proxy chips are only exchangeable for cash, whereas the BRICs-facing exchanges are 100% physically settled and have learned to cannibalize the Western-facing leverage markets to alchemize this synthetic discount into physical. And because gold and silver price is increasingly being settled outside of the Western-facing exchanges, lines have crossed and this process is unstoppable. Now, the crumbling structure of the COMEX casino telegraphs the last tool for the Fed to manage the price of gold against the dollar is failing. And given that foreign exchange gold markets and related derivatives are estimated to be around $70 trillion when you add in all the derivatives, it leaves the Fed two choices: allow the COMEX to default, spiking interest rates, or to revalue gold higher against the dollar. And if we pop in and look at silver, again, this is October the 2nd, looking at silver, although NSFR compliant silver has also been dragged lower, the focus was clearly on trying to trick out as many CTAs holding 96% leverage gold futures bets as possible, really impacting silver. However, with far less silver flowing through London, the Asian-facing physical markets are setting the price. And if we pop onto the weekly charts and look and to eliminate the immediate chart chatter, we're most definitely seeing silver, as I say, breaking out. So note the highest fix since December 2012. That's not going unnoticed. This is also the breakout point where we've said that where the short stops exist. They've managed to pull it back a little bit, but really a breach through that, and we're now going to move into what we discussed last time, the 35s and then the 40s. And this explains the battle at the rapidly contracting December to spot contango, which is spot $32. The round, it's roughly equivalent in this futures chart to $32 is approximately 32.28, and we've seen that being gamed. But this spread is about to shrink. It'll shrink to either par or backwardated to spot by next month. So to illustrate just how stressed the cartel is finding themselves, we captured up to a 24-cent spot premium in the in-delivery October contract on Monday as Indian buyers lined up at the back door, a COMEX store, to load out their longs. We talked about these guys being very active in the silver futures markets because simply you can't trust anything that can move, because it's not NSFR compliant. Anything that EFP into London, you can't trust. Can't trust remains as an unallocated position. So this means that all these positions that flowed out at 24 cents premium to this October contract that was expiring, they were underwater by $1,200 a contract. That's $1.3 million offside. And these are the little clues we look for. Now, as far as gold and silver are concerned, given Chinese Golden Week runs into a very likely a politically gamed non-farm payrolls beat on the 4th of October, on Friday, we should expect some additional short-term volatility, but this depends on where we identify where the central bank buy traps have been set. And there are two, and one has already been triggered and is in play. And the one that's in play is this one here. And we've identified them a long time ago, and we laid them out for each one by one, they're being blown through. So 26.50 spot equates to 26.68 or thereabouts in gold futures. So into the scramble to mark spot gold bets to market sub 26.50, we've evidenced a large layer of waiting central bank sized limit orders being tagged, forcing commercials to back off generating downside momentum, which is what happened here. They were desperately trying to garner downside momentum. And while we expect thinner liquidity to continue to be gamed, we're also aware that the PBOC is not absent this week. And along with India, Russia, and Saudi, any dips will continue to be actively capitalized on. Notably, the official interventions had to wait until after the last AM fix before China disappeared, before the gaming could begin. China is back next week. The point we're trying to make is just the China's retail market that is absent. Now, the second, much larger layer sits at 2600 spot. That's about 26.18 in futures. However, this is so unlikely. We actually doubt there are enough CTAs to rinse out to come anywhere close to opening up such a dip. There would be a huge opportunity, unless there's a stock market collapse, perhaps, which could evidence some CTAs dumping their long gold hedges into a stock market collapse. So close to the election, non-farm payrolls is likely to be rigged as a politically sought beat. So these massive central bank bids are hoping for a dip into these bids. We doubt they're going to get it.
All right, Andrew. Hey, thanks a lot. That really answers a lot of our community and our subscriber questions that they had here. Now, can we look at what you expect as we now progress through Q4?
Great, Shane. This is where it gets really interesting. The fourth quarter that commenced yesterday, we're recording this on Wednesday, this is the 2nd. So it's just started. So let's have a look.
I've just placed in where the last few episodes have been recorded, and so this one will be today here. So essentially, just looking at, as we assessed in our last episode back here, structurally, at the end of the third quarter action, which we've just witnessed, was very, very similar to what we saw at the end of the first quarter, where we also noted the distinct change in behavior around the Asian-centric AM gold fixes. Now, while back then Indian retail buyers had switched horses to silver at higher gold prices, the Indian central bank continued to buy gold at any price, joining forces with very aggressive Chinese buyers who've relentlessly been populating the AM fixes, which we continue to track all the way up, and confirming our assertions back then that even though it wasn't being reported, or is very late in being reported, Indian central bank buying has just continued to be very strong into a succession of all-time highs. Then, following India strategically cutting gold import taxes in August, Indian retail gold demand has also returned into all-time high dollar gold prices. Especially as we go into their auspicious gold festivals, which are just about to commence. So again, this, along with reported Russian and Saudi central bank buying, is worth noting as we run the official gauntlet capitalizing on this week's thin liquidity, which we're seeing evidence of here. Also, given non-farm perils is fully expected to be rigged by the White House into a politically sought beat, we should expect such a beat to be gamed. Hence our focus on this massive central bank bids sitting at spot gold 2600 again. So if they rig a beat of such large size, well, you could probably see some kind of pullback. However, there are going to be so many buyers coming in, and also with China coming back in basically on Tuesday, we would likely see some short covering. Just looking at all the options here. So just like their huge misstep in February when they made the mistake of breaching similar size central bank bids at 2000, a PPT breach of these bids $600 higher, even if we took this level, will trigger such large BRICS-centric bids that it will force an even quicker move into the 3000s.
Hey, Andrew, as we head into the BRICS Kazan meeting later this month, do you have any updates that you can share with us?
Yes, Shane. The day after spot gold recorded an all-time record high, and that was at 2668.90. That was the record high AM fix, that is. Last Thursday, that was, which we illustrated also printed an all-time gold futures high at 2708.70. You saw that on the charts. What I did was I met with a very large first-tier liquidity provider who is one of only 4 liquidity providers gearing up to provide initial liquidity into this BRICS-facing mBridge platform. Now, this reaffirms that the estimated necessary liquidity has been secured, sufficient to at least kick off trade on this historical game-changing platform after the Kazan meeting. Now, what is being missed by many skeptics as we approach the launch date of this platform, of this, I have to make the point, globally fungible 40% gold-backed stable coin token is backed by zero counterparty physical gold. It has to be understood. Given this platform has front-run several other initiatives also yet to roll out, including Glaziev's beta-tested gold-backed commodity currency that we've been tracking for about a year and a half, it's no coincidence that the BIS had positioned itself long gold ahead of reclassifying gold as a first-tier asset class in January 2023, well ahead of its debut launch on the 22nd of October upcoming. Now, all that was missing to benchmark thousands of tons of accrued BRICS gold reserves to ultimately control the price of all currencies and assets has to be understood. This is big enough to do that. It needs to be sufficiently liquid, and this sufficiently liquid decentralized, and I will make the point, decentralized trading platform that utilizes a non-dollar denominated gold benchmark. So this BIS sanctioned mBridge 40% gold-backed stablecoin is readying to launch in just actually when you get this on Friday, it's just 12 global market trading sessions away from when this, as I say, from when you get this. And as explained to me, it is sufficiently liquid to provide the growing number of BRICS members and the current growing 49 nations that applicants that want to join. And bearing in mind, we're talking about, this is a group who either produce or consume 85% of all global commodities. So what it needs to do is needs to be liquid enough to provide the necessary alternative sanction-proofed, de-dollarized means of exchange that they all seek, especially as we move into election uncertainty, sanctions, and really most worrying, unprecedented geopolitical escalations that risk dividing East from West, or worse, World War III. Now, while the US is fighting the launch of this de-dollarizing platform, for obvious reasons, we have been following you remember we looked in the last couple of episodes, we looked at the recent US carrot and stick attempts to rein in the Chinese BRICs gold anchor. However, these efforts absolutely ignore the fact that the BIS diverged from the Fed's dollar gold suppression scheme at the moment they revalued gold as a first-year asset class in January 2023. So it's really, they're on their own. And we've also been reporting, and I mean the Fed is on its own. So we've also been reporting that every single first-year bullion bank has also been going long for their own book since March 2020, when the risk of playing this 50-year long old spot asymmetric short COMEX price suppression scheme, it blew up, if you remember, into COVID refinery shutdowns.
Yeah, Andrew, I remember that you reporting, it was back in, I believe it was March 2020 from the Live from the Vault episode that, a lot of liquidity providers, including the Swiss and the UK making bullion banks, they shut shop following these massive losses back then. This is when you identified the Bank of International Settlements, which is the BIS, that brought forward the implementation of Basel III, the NSFR gold revaluation timeline.
Yeah, this left the Fed's plunge protection team, the PPT, is the only central bank still trying to hide the rate that the dollar is devaluing against gold. Now, it's not that gold's going up. It's just that the dollar's devaluing against gold. And they employed, but they also insured the agent banks, first-year banks privileged to have gold accounts with the Bank of England, so as to continue to play this lopsided asymmetric game. But as we've been pointing out, with traditional dollar bond correlations having broken down, they are deeply and increasingly offside. The Fed is increasingly offside on their long dollar short gold bets against gold. And they're undoubtedly in the process of folding their hand. So what is clear, with BRICS nations being able to take ownership of a sanction-proofed gold-backed medium of exchange, it segues into the forging of a polycentric system of international relations where we will see borders dismantled. Historical enemies will find it more equitable to trade, not fight, ultimately leading into a multipolar military alliance to secure peace in strength. The polar opposite of what NATO's aggression mandate is currently trying to do. And to give an idea of scale, even using the most conservative aggregate estimates of current BRICS nations' gold holdings, that's official and unreported monetary gold acquisitions, with the lion's share, of course, of this monetary gold is being accrued by the BRICS-related Sino-Russian Gold Alliance, which was established in 2013, but has waited for the fourth quarter to pull the trigger. Now, these unencumbered first-year physical gold assets vastly exceed the unaudited and empirically encumbered 8,000 odd tons of Fed-traded US Treasury gold. So as to easily control, I mean, it's so lopsided, they're going to easily control the global fiat gold price. Furthermore, with the BRICS nations having seized control of the physical gold price settlement process, it provides the BRICS nations an option of revaluing gold. The early process of this revaluation process is already underway by stealth. We pointed that out last time. Look at what's going on. Under the noses of the mainstream media, this stealthy gold revaluation process began the very moment the BIS strategically revalued gold as a first-year asset class, as I say, on the 1st of January 2023. And it was only after gold broke out above 2,000, as we saw when I demonstrated in the charts and looked at, that was in mid-February. It was only then that Bloomberg and the mainstream media deduced that the dollar price of gold was rising without attracting Western-facing EFP inflows. In fact, it was occurring into EFP outflows. And the mainstream media waking up to the fact that gold was rising, driven by global central bank physical gold demand. No sugar, Sherlock. And it's spilled out that every global central bank, except the Fed, have been adding to gold reserves, while the Fed has been caught holding a massive, unaudited, rehypothecated, underwater gold position. There is only one solution: confiscation or a forced gold price revaluation. And given that the gold price is being globally settled outside of the US-facing markets, liquidity providers estimate a gold price confiscation effort would backfire against the PPT to the tune of at least $10,000 per ounce, as it would trigger every single central bank to repatriate every single ounce of gold loaned to the US Treasury.
Now, Andrew, the scale of this de-dollarization process is just not being reported by the Western mainstream media as like much of this information. Can you sum up what you've been reporting since gold broke out back in February, and where is this leading?
Yeah, let's just take one last quick look at the charts.
So as we've been pointing out, acting as the anchor point for the upcoming BRICs currency launch, it was no coincidence that the Beijing stealthy de-dollarizing mandate stepped up significant after Beijing's well-timed launch of the Shanghai Futures Exchange on the first day of the second quarter, right here. Now, by design, these speculative futures buyers have become assistive in significantly driving up the dollar value of the over 60,000 tons of combined official and citizens' gold reserves. And although these Shanghai Futures Exchange flows were speculative, in order to satisfy this tsunami of physical demand, and it is physical, Chinese liquidity providers had to source this gold out of Western-facing, synthetically underpriced, 96% leverage COMEX futures markets. BRICS country central banks have learned to alchemize the Fed's gold price suppression mandate. And following the BIS revaluing gold as a first-tier asset class, it opened up the COMEX EFP conduit to be demanded for T+1 physical delivery, forcing this 96% leveraged unbacked COMEX gold to land fully funded into the 10 times larger NSFR-compliant deliverable FX gold markets. And because this wall of Shanghai Futures Exchange-driven global demand was being driven to fulfill physical demand outside of the CME LBMA ring fence, this gold demand impacted the Asian facing T+1 deliverable AM fixes. And that is why we've seen significantly tightening up global supply and then just locking in all of these higher stair-step supports that we've been tracking. So since the 1st of March, each swathe of momentum-driven Shanghai Futures Exchange buying has been sufficient to elevate global fixed prices just long enough for the physical support markets to adjust to these higher prices, thereby underpinning each stair-step physical support. Now, this action, evident around the usually thinner AM fixes, telegraphed an impossible to ignore change in behavior and has seamlessly endured through the entire 7 months through the end of the third quarter. As I say, driving gold into these successive higher stair steps, which since the breach of 2600 spot, which happened after we recorded the last episode, but said these were going to get magnetized. What this did was expose the commercials forced to close short into the top of this higher range, all-time high range. And it's impossible to ignore that global central banks are surgically attacking the paper gold cartel's mantra of selling paper gold at every pit open in the hope they can suck in enough coattailing CTAs to take the bait. Step back and look for 1 second at the longer-term charts in silver and also in gold, where we 100% target $3,000 gold, which is pretty much where all of the central bank, all of the first-tier banks are now targeting.
While the COMEX speculative open interest that is, the number of chips that are being borrowed from the casino, is historically very large and therefore extremely rinsable. Into this mix are actually a lot of sticky longs using gold to hedge risk and geopolitical market risk as well. In other words, although leveraged, they're using gold for what it says on the box. And while we would expect some CTA fresh froth to be rinsed out from time to time, which we have seen, given the Asian bank commercials can't risk adding naked shorts, they can't deliver into this an already growing wall of still undelivered T+1 overhang, meaning that when gold, as we explained in the charts, when gold gets delivered, when gold EFPs or moves into the NSFR compliant spot gold market, it's deliverable. Has to be delivered in one day. T+1 is what we call it. So there's a massive overhang. They're still undelivered and it's accruing. And these pullbacks are limited. So to how many CTAs that really these insiders can be tricked out, can trick out, or that they can short cover into. Now, these healthy consolidative dips will continue to be shallow because it gets rid of the froth. And in aggregate though, first tier liquidity providers assess gold will be magnetized into at least $3,000. And that's just the next staging point, with most first tier banks now assessing this gold price target. Almost all the first tier banks now have gravitated up to that price level. Now, notably, the usually predatory swap dealers, that's the primary agent banks acting on behalf of the Fed, interestingly, they reduced some of their short bets and short positions into the top of the current range that we demonstrated. And really, as the physically driven move higher, it blew through both of those identified central bank buy stop levels that we looked at 2,600 and 2,650, evidencing these NSFR compliant central bank bids, adding to the still undelivered series of T+1 delivery obligations, getting worse and worse for them. And while CTAs are coattailing them, yeah, of course they will, these physically driven stair steps higher, are underpinning them, because these gold levels into the top of an all-time range are consistently being underpinned by foreign exchange and central bank buyers. COMEX-centric dips have been shallow enough to miss all but the most highly triggered CTAs. I mean, so in other words, the most highly leveraged ones. We're talking about the 96% leveraged CTA long stops. So really, pretty much all of these guys, to the degree that they can not risk digging a deeper hole, these guys are pretty much done. And this has offered very, very, very few opportunities for officials to actually push back. So just as we assessed in our last episode, while there is some CTA froth to yet rinse, what is missed is this offsetting huge T+1 overhang of as yet undelivered NSFR compliant gold delivery obligations that will continue to force the commercials to hedge this exposure with long spot gold positions and or to capitulate into the top of the current range, which we are seeing both of. It will not be realized, and it is exactly why we expect very strong central bank demand on any such shallow pullbacks. And as also assessed in our last episode, it's the same story in silver. These same actors are increasingly being forced to jump to the tune of massive, and I mean massive, Indian and Chinese physical demand, with much of the flow bypassing the LBMA cartel altogether. And while this is not evident to Western-facing traders, it is tightening up global supply at current prices. Even Goldman Sachs sees silver underpriced, sub $37. And we know they're long for their own book. The BRICs Kazan summit aside, there are just really a couple of other underlying bullish factors to take on board as we wind up this episode. Gold now moves into very strong gold buying season. That's auspicious Indian festivals. They commence. We've seen the World Gold Council suggesting European pension funds invest into gold versus bonds. In other words, sell bonds, buy gold. And we're now evidencing this large Swiss money actually appearing into the fixes, which is interesting. So it's happening. Also, a big thanks to Dave Kranzler, who contributes a lot to Kinesis as well. A great big thanks to him for drawing my attention to the Bank of America report that gold has surpassed the euro to become the second largest reserve asset after the US dollar. This is mind-boggling stuff. Most people do not comprehend this. And if we vend this into the bigger picture, this impossible to hide official designation fails to capture the hidden 80,000 tons of monetary gold reserves the Sino-Russian alliance has accumulated. That's 40,000 tons for the PBOC, 25,000 tons of Chinese citizens' gold, and Russian and residual BRICs countries' accumulations of about 20,000 tons. Well, guys, thinking about this, there's only one question left to ask to our loyal subscribers. Are you doing what every other central bank is doing? Protecting your wealth from fiat debasement with as much physical gold and silver as you can? I hope so.
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical silver, buy physical gold. Make sure it's backed 1-to-1, and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. So please help keep spreading the word about this channel by hitting that like button. If you haven't already done so, hit the like button, share this information, get the word out. And if you haven't already subscribed, you can subscribe right there. And if you click on the bell, we'll notify you as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.